Welcome back to Indianomics. We've been speaking with the Reserve Bank of India's Deputy Governor, Mr. SS Mundra, who's in charge of banking supervision and in that sense, the most watched man by the financial sector. Mr. Mundra, this sustainable stressed asset structuring, that scheme that RBI put out, has its own set of moral hazards. I mean, you're actually telling the banks that the guys who have unsustainable debt should be helped. Isn't this a moral hazard?
Why you would say so? Let me put a
No, I'll tell you. Suppose you have two steel companies. One of them is making enough EBITDA to just pay his entire debt. He has one interest cover. And another guy has EBITDA which covers only, probably 30% of his debt. He is going to get help. He, in all probability, has gold-plated his capex. He, in all probability, was not the most economical producer, was probably an uneconomic and less productivity-oriented producer. He gets the help. The guy with better productivity and better honesty is not getting help.
Okay. Now, yes, I accept that there would always be some moral hazard in this kind of situation. But let's look from the viewpoint, number one, why this situation has come. The situation might have come for the regions which are completely beyond the control of this particular promoter. Okay. And if you see the trajectory of various measures announced right from the krill, then JLF, CAP, formation, SDR, 525 and now S4A. S4A is particularly only intended towards the promoters which have run into difficulties for not any wrong intention or malfeasance on their part, but only for the difficulties which were beyond their control. I take your analogy, but it's quite possible that one promoter had set up a plant in the part of country where it didn't face the hassle. Other one had put up the similar plant in another part of the country where he faced a lot of hurdles and there was a time overrun of 4 years. Now you are rightly, but at the same time, what are the options? You have the option, either you say that yes, let us abandon the project, let the productivity, let the employment go, let the ecosystem which is around, or the second option is that you try, give it a fair chance. But yes, there has to be a proper mechanism at least to deal with these two differences. Differences are only thing that in the first situation, because plant is running efficiently, whatever gain comes, this gain would be purely of the promoters. Whereas in this case, there is a provision that when gain comes, a principle of proportionality should kick in, and then the gain should be equally enjoyed by the lenders. In first case, lenders would be only entitled to their contractual rate of interest which they would run. In this case, they can expect, if things go well and everything is coming back, they can expect to get something much more than that. So I think that is the trade-off. Okay.
Well, I have a question both on promoters and on bankers, but first let me handle the promoters bit. I heard from fairly reliable sources that you are planning something to what he called read the riot acts to habitual defaulters. So something more is coming to warn promoters or punish them in some fashion.
I think
defaulting promoters.
No, right. But every day, I think day in, day out, what we have been reading is that riot act only. All the provisions which have been put in are designed in that direction. If you look at the SDR is primarily meant to drive out the promoters who have not played fair. What is further important is that by our wishing alone, not everything can accomplish. RBI is a regulator, and RBI is considered to be having substantial powers, but we don't have all the powers at our command. So it was very important that many other players in the act should have become equally sensitized about the possibility, and they also come into this with the similar kind of commitment, which they have, you must have seen gradually that many of them have come. So it will be a collective endeavor.
All right. Now about the banks. You said that bankers will be able to avail of the upside. So far, promoters have been, or at least the one set of promoters have been able to cheat the bankers of all that upside. Personal guarantees. You are saying that for the sustainable portion, personal guarantee should be demanded. by now all those guys would have transferred their assets. I mean, what will you get with that personal guarantee? And diligence, the governor made it so clear that even where you were irrationally exuberant in lending, even if you had taken good care of your collateral, it would have been good. It would have been. Is there any mechanism in place to ensure that the banking system's after sales service, its diligence over its collateral is, sharpened? It doesn't seem to be existing, and that was admitted.
Is a big question, and
so I'm just asking.
But I'm just struggling to say that how can I reply it so that it doesn't consume one of your entire program. It can consume one of your entire program if I go into all the dimension of this. But see, understand one thing. One is you say someone, okay, his personal guarantee is there, but the asset will be transferred. It will be very difficult. Yes. But then, if it is possible, or you have seen the many cases for a variety of reasons. If someone is prepared to spend a disproportionately long time in Tihar and start enjoying the lifestyle in Tihar, then it is one thing. If someone is prepared to call a recluse from the country and prepared to remain confined to another country is another thing. So while system may grind slow, but then when it grinds, it grinds fine. So let's not be so skeptical about the system that people can get away with any kind of thing. I'm
wondering if anything is in place to ensure that the bankers are putting in better diligence.
I'm coming to that. Yes, that is very much. If you look at the whole S4A process, then it's not something that few bankers will sit and decide something and implement, and maybe at times the whatever is designed is more to kick the can down the road rather than deal with the problem. So all those mechanism would be there. There is a direct correlation with the cash flow. There is an oversight committee. There is a TV valuation. TV valuation should be from a reputed company and not a big consulting firm from some small place, not like that. So those mechanisms are there. Unlike the previous system where the upside is more on a negotiation, some clause of recompense which will sit down, that is what all happened in the past. I'm not. Here upside is because there is an instrument, and instrument may be listed instrument, is a trade instrument. So it is not a upside which one has to negotiate or assume about it. It can be directly through the market mechanism. So I think it's a much better mechanism and structure than what we have seen in the past. Okay,
we're running out of time, so my question now to you is exactly based on this quality of banking, especially in the public sector banks. You are a frequent visitor in the bank board bureau meetings. As well, you've been a career commercial public sector banker yourself. Have you noticed any concrete steps to improve governance in bank boards? As I see it, the BBB is making appointments. Then what is the point in having a good board inside the banks? Likewise, the negotiations on, whether this sustainable and unsustainable debt is good or not is going to happen by a committee appointed by IBA. Where have we improved the public sector banks?
I think there are several steps. It won't, of course, I agree. I won't say that we have reached to the most ideal point, but at the same time to say that nothing has been done would also be, I think, truth lies somewhere. So the formation of Bank Board Bureau itself is a move forward. That at least you have detached the process of identifying such people purely from the bureaucratic system. And there are three separate, groups which evaluate him independently and all that. Then the split of the post of chairman and managing director. This is another move forward. But yes, I would say a lot more would be needed to be done. I feel at times concerned that at times forget about the right kind of quality on the bank board. A number of bank boards are having vacancies. We talk about who fill that vacancy, and their quality is the second stage. First, the vacancy themselves are there. So that is a concern. And I think all the time we have discussed enough about the top management in the bank, continuity, bringing, that is all fine. I think we need to find a time to look at the middle management. Bank is not run by...
Is BBB doing that?
No, it's not for... But I think it will be unfair also to, or unrealistic to expect BBB to take that entire. It is for the individual bank management.
So what is the next 1 or 2 steps we can expect by way of PSU bank reform?
I think the one thing is immediately after the top management, the rung which is typically consisting of GM and DGM, there is a strong need to strengthen that. Maybe it is by way of intense kind of training to them, exposures, if need be, do some lateral recruitment for the time being till you can grow your in-house talent. That will be very important. The whole risk management. The risk management has to move from the compliance to really understanding the risk, and even at the board level, the risk management committee, I think, need to be they should devote much more time. So these are few areas
that BBB is working on.
Yes, at least the broad architecture of it, which they should be constantly.
So we should expect something in a quarter or 2 to be in place in terms of improving these metrics.
I said these are these are the suggestions, or these are the messages we are constantly giving. Let's hope that since there is a constant focus, so let's hope that they would get implemented.
And finally, we have been waiting for quite a long time from the banks and the government for a stressed asset fund. We were told there would be 2 stressed asset funds, one for working capital and one for expansion capital, last mile capital. Are we any closer? Who is putting the money? Is government putting NIIF money?
I think if you ask me, as a regulator, we can only say that a certain structure of fund was presented, and more from our viewpoint that whether it will be acceptable or it is within regulatory framework. So that is something which has already been indicated. Now, as far as the funds coming into being itself, this is, I think, more for the government, bank, and maybe even the other players to move in that direction. But my sense, if it is a fund which is partly bank and partly government, then probably we are almost back to the old situation. So whatever the shape of the fund may be, it would be better that it has a fairly independent private kind of character. And to call these actually the stressed assets fund, I think we need to find out a new nomenclature for them, because they are typically not meant to take over the stressed asset from the banking system, but provide 2 kind of support, one where the equity support is needed and one where some last mile funding is needed.
Okay. Well, we have ended the Rajan era. And 2 of the legacies of the Rajan era, or maybe I'll only stick to banks, the legacy of the Rajan era has been being very strict about NPAs, probably in the second half of his tenure, but that demand for provisioning and not withstanding nonsense about whether it is loan to a Punjab government for food credit or to discoms, to provide correctly. As well to resist institutions like the bad bank, which, as you said, may not be buying assets at the right market price. Will these get tweaked, diluted in a new situation?
I think a very short, number one, a factual correction. We have no way ended Rajan era. Rajan era is very much there, and I think we are in that era for a couple of months. So to just reply what you said, we have still not hit the rewind button. We were on play mode. Probably we will be moving toward the fast forward.
Oh, that's very good to hear. Thank you very much, Mr. Mundra, for joining me in this conversation.
Always a pleasure.